We got some earnings here this afternoon. Salesforce being the highlight for cloud companies, but we've also got Chewy trying to fix a broken chart after a nice report last earnings. So some fun names here. Caroline Woods and Kevin Green going to help me sort through them, our senior markets correspondents. And good to see you guys both. So I think Salesforce probably going to be the major potential mover here, Caroline, in the afternoon, given the stock has been firming up alongside a lot of the other companies expected to show some type of AI impact in the cloud. They also raised some prices over the last couple quarters.
Yeah, although the price hikes, the latest price hikes won't be reflected in these results, but it will be interesting to see if they give any sort of commentary in terms of how that could impact outlook. I know analysts are very bullish on Salesforce heading into those results. I will say I haven't seen those numbers cross, but I am looking at Five Below's numbers crossing, and it looks like we're seeing some losses, some pretty steep losses, because this was a mixed report. Earnings did beat by a penny, 84 cents per share, topped analyst expectations of 83 cents per share. Revenues did rise 13.5% to $759 billion, but the expectation was for a little more than $759 million. That would be very impressive for Five Below, versus expectations of $760.2 million. Comp store sales rose 2.7%, whereas comp transactions rose 4.5%. Now I'm taking a look at the outlook for Five Below too, and it looks like a miss for revenue. For Q3 revenue, they're expecting $715 to $730 million. That would be sequential decline, of course, compared to what we just saw for Q2. Also below analyst expectations of around $737 million. Meanwhile, Q3 EPS of 17 cents to 25 cents per share. Looks like that's also coming in below where analysts were expecting. So shares off about 6% in after-hours trading based on these results. This is a company that's really only up modestly so far year to date. And I am interested in the commentary. I know earlier this week we talked about Big Lots and some very cautious commentary from them. They saw a huge pop after earnings, gave up a big chunk of that, of those gains today. Obviously, they have bigger ticket items, but the CEO there said we remain in a very challenging environment. Our core lower-income consumer remains under significant pressure, has limited capacity for those bigger ticket items. Obviously, Five Below doesn't have big ticket items there. Everything's priced below $5. It does have a lower or younger consumer, which could also impact things, but I'm curious to see what sort of commentary we get to kind of piece together this puzzle of mixed commentary on the consumer.
Yeah, and like another example of a retailer on the low end just getting dinged hard on earnings at a time where we've heard so much about how they're providing an important service to a high inflation economy. Okay, put that to the side for a sec. I want to come back to that. Very good report there, Caroline. Thank you. Let's talk Salesforce. Numbers are out. Shares are moving and trading at $225 right now. Looks like a pretty healthy little beat on the earnings side to me. Operating margin of 17%, non-GAAP operating margin 32%. So the adjusted earnings seeing a nice beat versus expectations. It feels like that's what is important for this company at this point, Kevin, after a year in which people kind of gave up a little hope on them being a super high engine growth stock after all their deals.
Yeah, definitely. And also the guidance that they're providing for the fiscal year 2024 as well. They're looking at revenue coming in between $34.7 billion and $34.8 billion. She was looking for $34.65 billion. And even for Q3, they were looking for $8.7 billion to $8.75 billion for revenue. She was looking for $8.66 billion. So they did raise their guidance here, beat the street's expectations, beating both from the top and bottom line. And we've kind of talked about this. They've been transforming their business over the last 9 months, even 12 months here. And you're starting to see some of the results of that, really trying to get into some new areas when it comes to AI and continue to integrate that product offering to their existing clients and their existing portfolios, but also expanding out margins by reducing expenses. And I think they're being rewarded for it. And one thing that's actually very interesting, they've been kind of getting hit when it comes to some of these earnings announcements because they do guide very conservatively. So the market actually may appreciate the guidance of the upside even more than what we have seen in the past, because they have been trying to minimize the expectations, if you will, because they do know that they were going through some headwinds in the marketplace.
Okay. It's cruising right now. This is exactly what the doctor ordered, I feel like, Caroline, for the cloud sector, which has been trailing the chips on the year as kind of a secondary AI play. Maybe this has a potential for them to go in the same direction as some of these hardware companies.
I was curious about this one because Salesforce has been already kind of riding that AI wave, and expectations have heightened heading into this report. The fact that it's up more than 60% year to date. I was curious if 11% revenue growth did top analyst expectations. Wasn't sure if it would impress investors, but it seems to be the case based on the after-hours move that I'm seeing. I know that Dan Ives has been very bullish on this name. I was just chatting with him yesterday, bumped into him, and I know that he's really bullish based on them monetizing AI. Of course, it being the AI play, thinks that it can result in overall revenue increase by $4 billion plus by 2025. So, of course, interested to see what Salesforce has to say on the call, because this is a software company that has business clients that have been tightening budgets, right? And obviously AI budgets didn't even exist, say, a year ago. So it's interesting to see how well they've been holding up despite the belt tightening, if you will. But so far, all signs point to a beat and a stock that's higher.
Okay. The guidance, I mean, pretty darn good, it seems like, for next quarter. The fiscal year 804 to 806, the revenue basically in line. That revenue for the fiscal year, Street looking for 3465. So I mean, a slight little beat there, but it's really the next quarter profitability metrics that seem pretty impressive to me. So good enough, possibly, to lift the cloud group as a whole. It's kind of looking more by the minute here, Kevin, that bears are desperately in need of a hot inflation print tomorrow.
Yeah, but the market really has been targeting specific names that have been able to perform. We're not seeing rising tides lifts all boats type of scenario. And actually, you're seeing that in the semiconductor names as well. I mean, we have NVIDIA moving to the upside. You have AMD moving to the upside, but we also have some other names that really focus on analog or maybe focusing on sensor technology and things of that nature that cannot catch a bid. I think going back to kind of like what Caroline was talking about for Salesforce, I mean, if you look at their cost of revenues as well as their marketing spend, compare this to last year. Now, they've actually did a really good job on a year-over-year basis when it comes to growing revenue and improving their profitability, but their marketing spend actually went down. Their cost of revenues went down. So that's what you want to be able to see, because margins are then going to expand. That's why the Street is really rewarding this, and hopefully they're on that trajectory to continue this type of trend moving forward, and they don't plateau at this point in time. A lot of companies, especially those that don't have a lot of cash on hand and then maybe have to utilize the debt markets in order to finance their operations, they don't have that luxury of being able to wait and transform their business like Salesforce has been able to do. They've been able to really utilize their cash in an effective manner, and I think that's probably why we are seeing it move to the upside here. And we might see some analyst changes as far as price targets and ratings move very dramatically over the next 24 to 48 hours here, Oliver. I would not be surprised if we do see that.
Yeah, I feel like you're probably onto something there, because again, chips have been the highlight. Cloud has been kind of the wait and see story, so there could be a little bit of pent up bullish sell side, energy that hasn't quite been released yet. But Crowdstrike is a little bit more dull. Little change to the downside. The outlook for the fiscal year seems good on their bottom line as well, Caroline. But the trailing quarter beat for sales and earnings, not enough to really stoke a big rally just yet. It certainly doesn't seem like a bad report, though.
No, it certainly doesn't. And I think that earnings was the outlook was what was going to be very important, because we, of course, had that Morgan Stanley analyst just recently downgrade the stock to equal weight from overweight, saying that expectations for the second half of the year and for the full fiscal year 2024 were too high, and expected recurring revenue estimates to actually get cut. So when we take a look, well, actually, let's just run through the last quarter. EPS of 74 cents came in higher than expectations of 56 cents. Easy beat there. Revenue came in at $731.6 million. The expectation was for just higher than $725 million, so beat there. But then in terms of that full year outlook, EPS of $2.80 to $2.84, the street was expecting closer to $2.40 per share. So that came in better than expected on revenue of $3.03 to $3.04 billion. That's just slightly higher than Wall Street was expecting. Meanwhile, a little bit nearer term sees Q3 EPS of 74 cents. That topped analyst expectations on revenue of 775.4 to 778 million. So that also came in higher than expectations. So both Q3 and full year outlook coming in higher than Wall Street was expecting, but we aren't really seeing much of a move in the after hours on this. So maybe the earnings call will have to, maybe some talk about trends in cybersecurity spending, because I know that the Morgan Stanley analysts expected it to decline into 2024. But at this point, 87% of analysts on the street were bullish, have a buy rating on Crowdstrike heading into this report. So there was already a lot of bullishness. And this is a stock that, although down this month about 8%, is up more than 40% year to date. So it could be possibly priced in. We'll have to see. Yeah,
I think that's going to be an interesting test by the market to see what level of expectations for beats have already been accounted for in some of these year-to-date gains, especially for a sector that really, for a long time, has traded on valuations and multiple expansion. A lot of these earnings are starting to kind of look more like earnings profitability priority, which is ultimately where these stocks have got to go eventually. But I do wonder if that means their valuations will stay a bit more muted. The last CrowdStrike earnings were not terrible either, and the stock has been unched since then. So, I mean, is it possible that they're just not doing enough growth anymore? Annual recurring revenue still slightly below 40% is a pretty chunky number, Kevin. But I mean, if the market doesn't rally it, then what other interpretations do we have?
Yeah, so the market's getting used to the growth that it has seen over the last couple of years, right? I think that's kind of the call out that you're talking about here. We're not seeing that sequential or the improvement of growth on a year-over-year basis. And I'm not sure if that means that the company is plateauing. Look, when we look at this forecast moving forward here, they are focusing on the bottom line. That also foretells that the sales cycles in themselves are starting to slow down a little bit. So they may not be onboarding as much, or do not anticipate onboarding as many new customers or new subscriptions as the market has expected, but they have been able to improve their margins. So the bottom line number looks really good. And Oliver, this is not only just a CrowdStrike thing or a Salesforce thing. If you think about the environment that we are going to go into for the latter half of this year and going into next year, we were just in an inflationary environment for a year and a half. As inflation comes down, as prices go down, that's also going to impact revenues. The comp revenues are not going to be the same. And I think the market really has not realized that. They're really thinking that revenues in themselves is on a dollar for dollar basis are going to match what we saw a year ago or even 2 years ago. And that's just not going to be the case. And I think that's why we are going to see companies like we are right now focusing more on the guidance on the bottom line, because that's what they can control, and really trying to curtail their expenses because the top line growth just may not be there. We might actually be in an environment this time next year, where we see flat revenues on a year-over-year basis because their cost, or basically their sales prices, may go down 10% because of lack of inflation. I mean, that's something that could actually happen here in the next 6 months, 12 months.
No, sure, and I feel like the market has to prepare for the that situation as a possibility. So maybe that's why valuations remain kind of tied to some degree. Hey, let's close it on a positive note here. The hero of earnings 2 quarters in a row, Chewy, and the stock just got annihilated all this past month. I don't know why, because their last earnings were a surprise profit, and this earnings are also a surprise profit. What am I missing, Caroline? I mean, it seems like they're finally doing really well.
It looks like maybe things will turn around after these earnings, because it's getting a nice little pop on the heels of these results. Adjusted EPS at 15 cents came in 4 cents higher than analysts expected. Q2 revenue came in at $2.78 billion. That's an increase of 14% year over year, also higher than the $2.76 billion that Wall Street was expecting. I'm still looking for customer count. I think that's going to be key, because last quarter it reported, or in the last reporting period, it reported 20.4 million active customers. That was a decline of almost 1% and the second consecutive quarter of declines for that metric. So I'm just scrolling through now trying to find that. I think if we can see Chewy top that and actually start to see growth there, that would also push the stock higher. The company has said that it still expects second half growth in active customers. So let's see if they pull through there. Also interested to see about their expansion plans in Canada. I know that's been a big point of focus for Chewy and could possibly drive growth as well. So maybe some commentary around that. But we are seeing a nice little pop. Keep in mind, though, as you said, it is down 20% just in August alone heading into this report. So some may
really
say
brutal.
Expectations were low, that it might be an easy beat then here.
Okay, thanks. Good stuff, guys. Nice coverage. Kevin Green, Caroline Woods, much appreciated for the help here on some heavy lifting, bunch of earnings.